All right, everybody. Hope you're doing absolutely amazing. Welcome to our investor webinar this evening. Hope you guys are all having an absolutely amazing night. First of all, I want to thank you for joining our session this evening. The session that we have is something that I put together. It's really designed from the request of a number of our subscribers and a number of people that watch our daily market commentary that specifically had asked more for investment style concepts. So talking a lot about what are some of the things that we can learn when it comes to being better investors. So we're taking our trader's hat off, right? Taking the trader's hat off today and not focusing so much on trading. What we're going to focus on tonight is how do I think more like an investor? And it's longer term planning. And it's really what's happening in the markets over the course of this year. So there's a couple of you that I can see you all in the chat box. So do me a favor, those of you that are watching, type in the chat box. Just say hello and where you're from. I want you all to kind of get used to using our chat box inside of there. Just type hello and let me know where you're joining us from. Like to get to kind of know who's in the room. So Carl and Arlene, welcome. Hope you guys are doing great. I know Diego in Dallas. Awesome, Diego. Glad you could join us from Dallas. Daniel in H-Town. I'm right down the road from you, Mr. Daniel, in beautiful Kingwood. I got Dew in Fort Worth. Excellent. Good. Hey, Trent. Good to see you, brother. Hey, Kevin. Where you been all my life, man? You got to make sure you got to reach out. You got to reach out. All right. So great to see all of you guys that are here. Really, really appreciate you taking the time. As we go through this evening, a couple of things. First of all, I really, really want you to ask any questions that you want. Those of you that are regular subscribers at tradersarmy.com know that I am a very, very big proponent of utilizing the chat box and asking whatever questions you want. And here's what I promise. If I don't know the answer to the question, I'll figure out a way to get it and find it for you, even if I don't get it for today. But I will do the best I can to give you the best answer that I have. Now, our agenda, we're going to go for probably the next 45 minutes or so, 45 minutes to an hour, depending on how many questions that you ask. But currently our agenda, we're going to talk about the current state of the U.S. markets. What's happening in the U.S. markets from a big picture perspective? Where might they go? What do we see some of the threats that we're looking at in the markets? And those threats that we may see in the markets, what can they do to your retirement portfolio? Because that's something we need to consider. I want to talk about the line in the sand for investors. And a line in the sand for me is, I use that term line in the sand, meaning I need to draw a line in the sand where I say, I will not lose any more money. Because here's the thing, when we think about investments, you think about your retirement portfolio. 10 plus 10 plus 10 plus 10 plus 10, right? Let's say you get 5 years of 10% increases. And I do this math. I do this math all the time, but I want to, because I think this is a big thing to consider. So one of the things, I'm a huge teacher of concepts, but let's just think theoretically. Let's say you have $100,000 account, right? You have $100,000 account, and your $100,000 account, you earn 10%. What do you now have? Right? $100,000 account, you earn 10%. This is not difficult math. I'm a guy from Pittsburgh. I can do this one. You got 110, right? 110,000. You earn another 10%. What do you now have? You've got 121, right? You earn another 10%. What do you now have? You have 133. You earn another 10%. You're sitting now pretty at 146, right? So I think it's 146. You earn another 10%, right? So you've earned another 10%, and now you're sitting at about 150. What would that be? Let's call it 160, approximately 160, actually about 161. You're at 161, right? So I've earned 10, 20, 30, 40, 5 years in a row, I got 10%. 5 years in a row, I got a 10% increase in my portfolio. But look at this. I'm up 61%, right? I took $100,000, to 161,000. After 5 years of in a row of 10% solid earnings, I've now taken that $100,000 account to 161. But what happens when I take that year where I lose 50%? What does that 161 turn into? Well, that 161 is now back to 80. So think about that for a few minutes, right? Think about that for just a few minutes. I'm up 10, up 10, up 10, up 10, down 50, and I'm not back to break even. I'm actually now down 20% from where I started. So what's important for us is to think about our investments and to say, where's that line in the sand where I'm going to get out of the market if it goes against me, so that I don't take those kind of hits. Because now, by the way, we'll never see another 50% correction in the markets again, right? Does anybody believe that? What do you guys think? Type in the box below. Do you guys think that we'll ever see another 50% correction in the markets again? I've been told that was a fluke and it'll never happen. Yeah, that's my thoughts as well. So my feeling is that it pays to have a way to make sure that that's protected, right? To understand that we've got some protections in place in how we set ourselves up. Okay, so let's move on and we're going to first start talking about the current state of the U.S. markets and where we are right now as far as our big picture. So when I'm looking at the U.S. markets, I really need to understand that there's really only 4 places that money goes in the world, right? There's, as much as we think about it, there's really 4 places in the world that money goes and where money kind of moves in and out of. And the 4 places that money tends to live are the stock markets all over the world, wherever those stock markets happen to be, right? It moves in and out of the gold markets, right? Money moves in and out of gold. It moves in and out of bonds, and it moves in and out of currencies. I'm just, for the sake of conversation, just going to say the dollar. Those are really our 4 major markets, right? Stocks, golds, bonds, and the dollar. Now, a lot of people would say real estate. Well, when money goes into real estate, where does it typically wind up? When money goes into real estate, where does it typically wind up? In which market? Yeah, it's not liquid for sure, but oftentimes when money does go into real estate, it winds up being packaged together as mortgages and sold as bonds, right? So they're very, very close to this. Now, that's a very great point. That's a very great point, Brian. Lately, they've also been packaged together as REITs in here. So those are really the 4. Now, the thing you've got to consider is that as the S&P, as the stock market over time, historically over time, the market looks something like this. And we go through periods of expansion and contraction, but it's always going up. By the way, why historically is the market always going up? Well, historically, the market's always going up because we're replacing stocks that are not performing with stocks that are performing, right? But there's going to be certain markets that are what's called inverse of our equity market at different times. So sometimes money goes out of stocks and into gold. That would be when they're inversely related. Sometimes money goes out of stocks and into bonds. And sometimes money goes out of stocks and into cash. Well, we've got to think about when and why it goes into these markets when it goes out of stocks. So if you think about it, when the market is really starting, when it's really falling and people have a tremendous amount of fear, when people are in fear after the market has fallen a significant amount, what do people do? Especially think about their 401ks, right? We got to think about what comprises the U.S. markets, and the U.S. markets are heavily, heavily comprised of the U.S. markets are very heavily comprised of investors that don't really look at their accounts ever. That's the 401k investors. But when they see, hey, look, last month I put in $3,000 into the account, but the market went down and I lost $4,000. What do? What do? Typically, Ian, you nailed it. They panic sell, right? They panic sell. That's all they do. They pull out, panic sell, get out, Chicken Little. The sky is falling, head for the hills, and they go to cash, right? So when the market is in that falling point, that's when you see that the market is inversely correlated to the dollar. Okay? Now, once the market has hit a very, very low point and we start to see a bit of a rebound, as the market starts to get a bit of a rebound, people don't necessarily trust it yet. Now, since they don't necessarily trust it and there's still fear from a market that just crashed, what do you start seeing advertisements for all over the place, right? What do you start seeing? You see advertisements for them all over the place, right? In an uncertain economy and with uncertain times, there's truly only buy gold. That's it. That's 100%. Gold then becomes that place that people want to go, right? People want to move their money into gold. So at this point, gold is the inverse correlation to our markets, okay? And so you start to see gold as an inverse correlation. And as the markets go up, oftentimes gold will go down. And throughout, remember, these are macro swings. It might be 10 years between these big swings. So, when I'm looking at inverse correlations, even on a daily basis, if the dollar goes up, if gold goes up, the market's probably going to go down, and vice versa. Frankly, we saw that yesterday, right? We saw that exact pattern happen yesterday on a smaller time frame. So when I talk about a smaller time frame, if I just use yesterday's example, this is let me put gold up here. Oops, that's not what I wanted to do. Hold on just a second. So I've got the S&P on the left and I've got gold on the right. Now, this is a smaller time frame concept, but yesterday, as the market sold off, what did we see happen in gold? Huge rally in gold, right? Now, today we saw the market rallied off of a really nice demand area, which hopefully some of you are able to catch some of that, by the way. The market rallied off of a really nice demand area. And while the market started to rally off, what did we see gold here do at the end of the day? We started to see a little bit of a pullback. So it happens not only on the big picture, but also on that smaller time frame concepts. Now, once you start to reach these highs, the institutional investors, institutions that have stayed in the market, and they're the ones that had the money to kind of control it, as it starts to get up near market peaks, when we start to see market peaks beginning to form and areas in the market that are a little bit more near the top and have not yet begun the big sell-off, what's the inverse correlated market that people are interested in, right? Which one are they interested in? Well, they're interested there in bonds. So this is why the correlation exists between these markets. Now, one of the biggest flaws, I don't know why that's doing that. One of the biggest flaws I think people make is that they think, oh, well, when the market goes up, when the market goes down, bonds go up. That's not always the case, right? That only occurs after big bull runs and at the beginning of bearish runs. Now, once those bonds start to be the inverse, now once there's true panic, people really start pulling out. And then what again is the big one? The dollar. Oh, and then by the way, we've started the whole cycle all over again, and it starts to head up, right? This is common flow of funds, knowing our markets. And Mike has a great point. For those of you guys that don't know, our Traders Army support is Mike. He's there. He's here to answer any questions that I don't necessarily get to. But Mike is here as well to make sure that we get all of your questions answered. But yeah, it depends on the type of bonds. High yield growth bonds, especially at market highs, are going to really, really, really be something that people are interested in. But as those bond prices fall, the reason people like it is because as those bond prices fall, the yields tend to rise, right? There's an inverse correlation. So that tells me I need to look at those four things. And I need to look at those 4 things. So let's look at those 4 things. Now, when I look at those 4 things, I'm going to use the actual contracts themselves, the futures contracts themselves on a bigger picture, or the actual index. So here's our S&P 500. So when I'm looking at the S&P 500, for those of you that are not chart readers, those of you that have not done a lot of chart reading in your time, what these are called candlesticks. And these candlesticks show me the change in price over a given period of time. So what I want you to notice here when I'm looking at these particular candlesticks is that up here it says MO. That means monthly. We're looking at a monthly chart, which means that each one of these individual red and green candlesticks represent 1 month. Now, when we're looking at here, if the candlestick is in green, that means that over the course of the month, we went up. If the candlestick is in red, that means that over the course of the month, we went down. There is no simpler way for me to describe it than that. It's the simplest way that we can describe it. Now, what you're seeing on the bottom is time. And once again, I know a number of you are traders, and this is very basic knowledge, but this, I really want people that are investors that are not looking at charts on a regular basis to be able to understand what we're doing. So if this is very, very basic to you, do me a favor, just hold on and give me a little bit of grace. This axis down here at the bottom represents time. And what we're looking at the bottom is time. And this axis over here represents price. So what you're seeing is a chart is nothing more than a graphical representation of the change in price over a given unit of time. Now, if you look here, we're going all the way back to the year 2000. This was about a 50% market correction. Approximately. We went from approximately 1,800 to around 900, somewhere in that range. This was another 50% market correction. In this case, we went from approximately 1,800, maybe I guess it was 1,750 to 666. No coincidence there, right? Another 50% market correction. And now we've really, really risen up at a parabolic rate since the 2009 market collapse. If we get another 50% correction, which right now we're sitting at 3,000, that would put us right about here. Right about this 1,500 mark. And we'll come back and we'll talk about this a little bit later as to kind of what that is. Now, where we are today, we're sitting at a market that's at an all-time high, okay? We're sitting at a market that's at an all-time high. And the market that's here at our all-time high is one that I think it's good for us to realize that just because we're at all-time highs today certainly does not mean that we stay at all-time highs. So when I'm looking at the market in general, I always tend to look at the S&P. Now, a lot of people have been trained to look at, the Dow. A lot of times people they're in their lives are used to looking at the Dow Jones Industrial Average. I don't use the Dow to determine our market strength. Why do you think that I use the S&P instead of the Dow? What do you think the biggest reason is for using the S&P 500 instead of the Dow? What do y'all think? Yeah, Ian and Denise, a great point. It's a much more, the Dow is only 30 companies, right? So it's a much smaller slice of the world. Whereas the S&P 500, it's 500 large cap companies, and it's much more representative of the entire market. So when I look at this, I've got to look at this from a perspective of we have a tremendous amount of strength in our overall markets. Now, the other market that is probably the second most widely viewed to look at the overall health of the market would be the NASDAQ, right? So the NASDAQ would be the next one. And this is the NASDAQ 100 index. So the NASDAQ 100 are the top 100 stocks in the NASDAQ index. I could also use the NASDAQ composite, which is the entire NASDAQ index, both of which are sitting at all-time highs. So in both of these markets, we're sitting at all-time highs. There's really no reason to have so much fear in our eyes. But one of the things I think that is dangerous, especially when the market's at all-time highs, is the fear of complacency and being lulled to sleep. So one of the things that we want to do is also take a look at, what are some areas that we need to make sure that we pay attention to when I'm looking at these markets. So what is my line in the sand? So let me show you what I'm talking about when I talk about the line in the sand. So the line in the sand, I'm going to skip ahead here a little bit and come back to this piece. So we got to look at see when the market might go down, because I don't know when it's going to go down. And if I don't know when it's going to go down, then I'm not sure exactly what the next step is and what I should do. So you think about it, how high can a tree grow? Well, if you keep cutting it down, you're never going to know, right? If you keep cutting down the tree, you never know how high it's going to grow. Same thing with your portfolio. How big can it get? Well, if you keep taking hits, then you're never going to know. And what pains me, right, drives me absolutely crazy, and what pains me is that I used to see investors back in when I used to travel all over the world teaching people some skills around trading and investing, and I was blessed to be able to travel all over the world to do that. I stopped doing it so I could stay home with my family and with my kids. But in that time, I saw so many people that had become a millionaire twice. And the reason is because they had worked hard, they worked all their lives, they saved, they put their money in their 401k, and then the dot-com bubble burst. 50%'s gone. Okay, I'm still working. I keep going. I put my money away. I save. I work hard. Boom. Now the 2009 bubble collapse happens. Now this is now 10 years later. So they're now closer to retirement. And did they get back in right away? Do you think people got back in right away? The answer to that is probably not. So the next step in that is I need to be able to get out before I take that 50% hit. So what we're going to look for are areas where buying and selling are relatively even. So in any market condition, I don't care what market we're looking at, S&P, Dow Jones, NASDAQ. Now, this is a slightly older chart, and I'm going to pull up a more recent live one here in a minute, but the concepts remain the same. If you think about price in any market, you have two competing forces. In any market, what are your two competing forces? What do you think? What are our two competing forces? What are our two competing forces? Well, supply and demand, those would be, Kevin, I would say buyers and sellers, right? I would say buyers and sellers are our two competing forces. So when I think about my two competing forces, which are buyers and sellers. So when we think about anything, I don't care if you're buying homes. I don't care if you're buying cars. I don't care what you're buying. If I have buyers lined up, so let's just call this a buyer, 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 and a buyer. They're all lined up. And I have inventory on hand. Inventory. Now, my inventory is provided by my sellers. So let's say that this is what I have. And I've got a product that's selling for $10. So my product is selling for $10. I've got this many buyers and this many sellers. Now, for every buyer, there has to be a seller. And I just erased two by mistake. For every buyer, there's a seller. For every buyer, there's a seller. For every buyer, we have a seller. For every buyer, we have a seller. So now, all of a sudden, what happened to my inventory? What did my inventory do? My inventory has been depleted. I have no more inventory in this area. My inventory is now gone. So what I need to do is I need to be able to attract more willing sellers. Well, how do I attract more willing sellers? Well, the way I attract more willing sellers is I say, well, you know what? The price is now $14. The price is now $14. Now, those buyers that were sitting there at 10, they may say, I'm not willing to pay 14. I'm going to stay here at 10. Well, at 14, all of a sudden, there may be a lot more buyers that say, you know what? I am willing to pay 14, and they line up to buy. Well, at 14, I may only have two sellers that say, yeah, I guess I'm willing to sell at 14. And so what we see is for every buyer, there's a seller. For every buyer, there's a seller. Now, all of a sudden, we keep piling up this inventory of unfilled buyers, right? Now, think about a market for a minute. What does a market exist to do? Ultimately, a market exists to facilitate trade. So those orders that are sitting there, the natural tendency of a market is to get those orders filled. The market wants to get those orders filled. So how would that look on a price chart? It would look something like this. As buyers and sellers are equal, prices are basically going nowhere. Once we run out of willing sellers, price goes up. And maybe until we run into more willing buyers. And then all of a sudden, if we run out of more willing sellers, price goes up again. These areas where buyers and sellers have a relative state of equilibrium, we refer to those as fair price value areas. Okay, fair price value areas. Now, a lot of this comes from a book by Laurentius Demir, who talks about price action breakdown, and he talks about fair price value areas. And I give him a lot of credit because the book's very well written. And inside of there, he talks about where are some of these. How do fair price value areas affect future price movement? Well, they affect future price movement because let's say that in this area we left behind a bunch of buy orders. When price comes back down to here, if it does, what's it going to run into? All of those buyers. And so we would anticipate price to rally. Why would price fall? What's the only reason price would go through that area? What's the only reason that price would go through an area like that? No more buyers. Okay? No more buyers means price is going to fall. So I'm going to go back to a chart for a moment. Now, in this case, what's the time frame of a chart that we're looking at? What's our chart time frame that we have identified? Okay. What is our chart time frame that we have identified? We've got a monthly chart. Very good. Which means each one of these candlesticks represents a month. Now, as price moves up, one of the things that we have to do is identify areas where price thrusts up as its own area where we have a relatively equal amount of buying and selling. So in this area here, a little bit of sideways price action, we're relatively even in buying and selling. Okay. So price comes up from that area and comes back down, and we retouch that new area. So what happens is your line in the sand would say, okay, if I bought right here, my line in the sand is this red line here. Now, in the world of trading, we call that a stop loss. I differentiate a line in the sand from a stop loss because a stop loss to me, I think trader. Line in the sand is I am definitively putting a line in the sand that says I will lose no more. And as we create new fair price value areas, our line in the sand will keep moving. So our line in the sand moves up. Now, as price goes higher, we have a new area of fair price value. So we create a new line in the sand, right? So right in here, we've decided, okay, this fair price value area, let's create a brand new line in the sand. Now, that line in the sand area gets created. Price moves away. Price then returns back into that area and moves away again. So we move our line in the sand up, right? And we move away from that area. We get another move down and a little move away. We move our line in the sand up. Notice what we've done here. I'm going to go back to when we started. When we started, our line in the sand was at approximately 800 in the S&P. By the time we got to that top area, our line in the sand was sitting around 1350. Now, what happens soon after? Boom, your line in the sand gets hit. Now, once your line in the sand gets hit, what do? We get out of the market. Very simple decision. Out of the market. No emotional thoughts, nothing to think about, out of the market. Now, you don't get back in the market until you create a new area where you see a line in the sand that can be created. So here we have a little bit of sideways price action and a nice rally up. and another area of sideways price action with a rally up. So when I have two of them in a row, I now have a reason to get back into the market. If you notice here, we have a little bit of a sideways price action and a rally up, but we don't get a follow through. We have a sideways price action and a rally up, but we don't get a follow through. Here we have a sideways price action and a rally up, another sideways price action and a rally up. So it gives you a reason to get back in the market. Now, when you get back in the market, your line in the sand goes under that last bit of consolidation, right? As we go up, you have a new level of consolidation. You move up that line in the sand. You move up the line in the sand. You move up the line in the sand, and you continue to move up the line in the sand until, boom, you're out of the market, right? Now, in this case, you're back in somewhere around 900 and back out somewhere around 1400. Once again, never catching the absolute top, never catching the absolute bottom. As an investor, you're not going to catch those. Don't try. Don't try. It doesn't make any sense to do that. As an investor, I'm not even trying. As a trader, yes. As an investor, no. Now, once again, I've got no reason to be in, 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 no reason to be in. Now we have a move up and then another area of consolidation, another reason to be in. Two in a row, two little areas of consolidation in a row. Now, mind you, these are monthly charts. So is this something that you need to look at every day, right? So we have an area of buying and selling that's relatively even after two consecutive higher swing lows. Here's another reason to get back in at about 800, right? Now, as price starts to rally up, line in the sand moves up. Area of consolidation, line in the sand moves up. Price comes back and comes close to it, but doesn't touch it. Price moves up, line in the sand moves up. We come back down again, line in the sand moves up. We come back down again, line in the sand moves up. We do it again, the line moves up. And we continue to do that all the way, okay? Does everybody get that concept? So now what I need to do is I need to determine where is the current line in the sand. And the only way to do that is to look at current market conditions. So what I need to do is, now mind you, I'm on monthly charts, okay? Now in this line in the sand concept, as those prices have continued to rally, this area here told me to get out of the market. I will say that at the end of December, the market was a little bit squirrely and said, okay, we should probably bail. This is really the first time in just about 20 years that it gave me a false signal. But it did. It pulled us back down into here, and then we rallied back up through it. Now, I love the fact that last month we had a little bit of a pullback, because what does the last month's pullback do for us? What does last month's pullback do for us? Yeah, first of all, Ian, it definitely provides buying opportunities, which is those of you that are Traders Army subscribers, we were talking specifically about the fact that gave us a buying opportunity, right? We talked about the fact that it gave us a buying opportunity, but what else does it do for us? Well, it gives us a point to now place our line in the sand. So in my mind, as an investor, my current line in the sand is going to be under here. My current line in the sand is going to be right underneath here. I'm going to put my line in the sand underneath the lows of this area of consolidation, right? That to me is the current line in the sand. That if we break down, we believe that price would fall to the next fresh area of consolidation. The next area of consolidation that's our freshest area. Well, in my mind, the next quality fresh area that makes the most sense is about here. To me, this is a natural pullback zone and a natural area where I believe that if we break through that next level, that we could see the markets kind of come down from. Okay? So that would be the level that I would believe that we can see the markets move down from in that region. Okay. Now, if that one were to be violated, if something were to happen there and that level were to be violated, in my mind, your next quality level comes into play at about here. Those are the two in my mind, most highly probable areas for market reversals on a deep pullback. If we break below here. Now, if you don't break below this area, what's the answer? What do we do? If you don't break below that area, what's the answer? Yeah, you keep on, you stay in. There's no reason to get out, and certainly no reason to overreact on minor pullbacks. Certainly no reason to overreact on minor pullbacks and allow yourself to get hurt when the markets pull back on you. Okay, so those are the two areas that if we break through 27.26, I think that this is the next most logical number for price to fall. Now, the last time that we broke through, we fell to the most logical area, which was this area of consolidation, and we rallied up. That area, in my mind, has been used, and so the next level would be somewhere down in here. Now, but you say, well, this is the long-term market. Chuck, I'm not really good with this whole areas of consolidation, and I'm brand new at reading charts. Let me give you one more tool that you can use. It's not quite as precise, but it's easier. Okay? For those of you that have friends or families that are never, ever going to look at a chart in this way and in this detailed level, another simple way that you can do it, and I'm going to give you, this is the simplest way that you can do it, is just use a moving average. Right? A moving average. So for those of you that are unaware, a moving average is nothing more than the average price over X number of candlesticks. So I'm going to switch from monthly to weekly. So when I do a moving average, I want to use a weekly chart. And I'm going to look at two different types of moving averages. Actually, I'm just going to use one just to make it simple. I'm going to throw in a moving average. I'm going to use the 50-week moving average. That's it. The 50-week moving average. So what that means is it's the average closing price over the last 50 weeks. And the idea here would be very simple. If we're above the 50-week moving average, you're in a position. If you're below the 50-week moving average, you're out of the market. And what that does is going all the way back once again to the year 2000. Above, you're in. Below, you're out, you're out, you're out, you're out, you're in. You're in, you're in, you're in. You have a little bit of a tweak here where you might have been booted out, but you're right back in. You're in, you're in, you're in, you're out. You're out, you're out, you're out, you're out. You're back in. You're back out, you're back in, you're back out. You get a few ins and outs. Now, these ins and outs don't come very close together, right? This is July 25th, and you're back in December. So the 50-week moving average is about the simplest way to do this sort of market timing. I call this reactionary market timing for long-term investors, right? Reactionary market timing for long-term investors. Now, question is, where do I put my money, right? Well, if I don't have this, where do I put it? So there's a number of different locations that where you can go and what you can do with it. Because one of the areas that I am a little bit concerned with is this concept of what's called a melt up. I don't know if y'all have heard about this melt up concept, but the S&P 500. This was an article that came out. I wish I kept this article. I'm going to pull this up. Maybe I'll put it in the comment section in the recording. But this is the concept is called a melt up of a classic bubble. And so the target by this guy Grantham, and he accurately predicted the fall of both 2000 and 2008. And so the reason for his move is the outperformance of quality stocks and huge overvaluation in the role of the Fed. And this I think this article was done early last year. But his point is that a melt up or end phase bubble within the next 6 months to 2 years is likely over 50%. And his target was anywhere between 34 and 3,700. If there is a melt up, then the odds of a subsequent bubble break or meltdown are very high, over 90%. And if there's a market decline following a melt up, it's quite likely to be a decline of some 50%. So this Grantham character is the one who had this, hold on a second here, who had this concept. And I found it to be very, very interesting. And I thought that it was a really interesting concept. And so it may not happen, but it is something to consider. It's Jeremy Grantham is his name, value investor. And it was this right here, brace for a possible near-term melt-up. Now, this was early last year. But I mean, the guy is very well known for what it is that he does on his piece. And that's where I got this information from. So now, do I think that's going to happen? Not necessarily. I'm not going to be able to predict that, but I can, at the very least, prepare for it, right? Now, many of you in here have 401ks. So let's talk about your 401k positions. And your 401ks are primarily held in what vehicles? What vehicles are those 401ks primarily held in? If you're in a 401k, you're in mutual funds, okay? So here's what's great. I don't need to know everybody's 401k. All of you that are in here, you're either in a 401k in somewhere in your life, or you're in a mutual fund, or you know somebody that's in a mutual fund somewhere in their life. So we went out to Kiplinger and said, what are the most popular funds in retirement accounts? So these are the list of the most popular retirement account funds. We have the Vanguard Institutional Index Fund, the VINIX. These are just equity funds. The Fidelity Contra Fund, the American Funds Euro Pacific Growth Fund. We have the Fidelity 500 Index Investor Fund, the Vanguard Wellington Investor, Dodge and Cox Stock Fund, Fidelity Growth Fund, and the Vanguard Prime Cap Investor. These are the most widely held mutual funds. So what we're going to do is we're going to take a look at each of these mutual funds. Now, just at a quick glance, the upper left corner here is the S&P. At a very quick glance, what do you notice about each of these mutual funds relative to the S&P? What do you notice about them? Just looking at all of them together. Yeah, Ian says they kind of mirror. And Ian says they mirror, right? Very strong correlation. So what I want to do very quickly is let's just look at these funds in a live market environment. This is the live market. And we're going to do a quick comparison of those against the S&P. Okay? So what I'm going to do in order to do that is I'm simply going to maximize this, and I'm going to look at the S&P, and then I'm going to look at the fund. S&P 500, Vanguard Institutional Index Fund. Can you guys really tell the difference? I can't. How about the Fidelity Contra Fund, right? Fidelity Contra Fund, slightly underperforming the S&P. Would you agree to that? Everybody agree that the Contra Fund is slightly underperforming the S&P? Okay. The American Funds Euro Pacific Growth is greatly underperforming the S&P. The Fidelity 500 Index Investor is the S&P, right? Very similar in performance to the S&P. If I look at this, this one I think I've got zoomed out more. Let me zoom in a little bit so it's a little bit more accurate. So what you'll notice as I go through all of these is that they all have similar shapes to the S&P. Aside from a lot of them, especially the later ones, have a bigger pullback and have not yet recovered, right? So what are we looking at here? Well, we're looking at the performance of the fund versus the performance of the S&P 500 in general. And when I look at what these are doing versus the performance of the S&P, what it tells me is that they are not as strongly performing as the S&P overall. So when I've got a mutual fund in my 401k, one, I'm paying fees to that fund, right? I'm paying fees to that mutual fund, and every single fund has some sort of a fee associated with it. So let me give you an example. A great place to find out about the fees of your mutual funds. And an easy thing you can do is you can go to this website called, I don't know if you guys have ever heard of it. It's called Google, kind of a neat website. But just type in a mutual fund. So for example, I've got one here, PAMCX. Every mutual fund has a ticker symbol. So this is the T. Rowe Price Mid-Cap Growth Fund Advisor. That's what this is. Well, if I just click on Morningstar, Morningstar typically does a pretty good job. If I just click on Morningstar, it actually gives me the analyst rating here. It's got a 5-point analyst rating on this particular fund and what it does. Tells me the yield and it gives me what's called the expense ratio. Now, in this case, I've got an expense ratio of 1.02%. Okay. So this fund has an expense ratio of 1.02%, which means that I'm paying 1% in order for that fund to perform almost exactly like the S&P. Think about that. I'm paying 1.2%. Now, converse that to something like SPY. The SPY is the S&P 500. Yes, the SPY is an ETF, exchange traded fund of the S&P 500. Still does have a fee, right? So my expense ratio on this is 0.095%. So that means that the expense ratio on the fund we just looked at is over 10 times the expense ratio of the SPY. So the expense ratio is your expense ratio is cut by over 90% when you go to the exchange traded fund, which mirrors the S&P 500 in general. Okay. Now it's just 1%. So what does 1% mean? Well, let's do a little quick Google search here. What's the effective compound interest? So let's just do a quick compound interest calculator. Okay. So if I just Google a quick compound, we'll just pick the first one on the list. It's Money Chimp. It's kind of an interesting one. So let's say you have $100,000 and you're not putting any more money into it. Now, when you have a financial advisor, do they want your money for a little bit of time or for a lot of time? What do you think? Do they want it for a little bit of time or do they want it for life? Yeah, they want it for life. So let's say over 35 years. Let's just say over 35 years. Now, what do you think is, I want you guys to tell me, what's a good interest rate? What's a good year in the market? The market in general, in a mutual fund of things like that. A good rate of return. Give me a percentage. Diego, I think 1.5 is a little bit light. Kevin says 7. I think that's okay. Let's do 7. Okay. Let's say 7% rate of return, and it compounds one time a year. So we calculate it. Our future value is $1,067,000. It's not so bad. What about our expense ratio? Because by the way, when the price of the security is shown, it's shown minus it's shown without the expense ratio calculated. So we take that 7%. Let's cut it down to 6. Oh, but wait a minute. I have a fund. I have a mutual fund manager, or I've got a financial advisor, or somebody managing my money for me. So now it goes down to 5, right? So let's take it down to 5. Well, now that $1,067,000 goes to $551,000. So think about the cost of the 1%, right? Let's say you're paying 1% to a financial advisor and 1% to your mutual funds. That's just taking your $1,067,000 down to $551 on a simple compound calculation. Now, this is just the math, but if you have a 401k and your choices are only to be in mutual funds, okay, use the mutual funds. But if you are self-directed and you've got the ability to self-direct, it probably, I closed the thing and didn't mean to. It probably makes more sense to, instead of doing the mutual funds, to look at an ETF, exchange traded fund. So here is a list of exchange traded funds that I think do a pretty good job. If this was the only list you ever had to use, I think this would be enough for you to be able to have a diversified portfolio. You've got large cap blend, large cap growth with SPY and QQQ. Mid cap value, mid cap growth, IJJ, IJK. Russell 2000 value, Russell 2000 growth. Now, for those of you that are unfamiliar, that's small cap, right? IWN, IWO. An emerging stock fund, EEM, EFA, Europe, Australia, Asia, and the Far East. Those are 2 international funds. So those, I mean, that is pretty much every equity fund you could ever need. And then there's an aggregate fund, a high yield growth fund, gold, silver, and a real estate fund. To me, you can utilize this checklist of funds. And what you do is you move your money to the ones that are performing the best and out of the ones that are not. So Ray asked a great question. Chuck, if you're using the 50 moving average to get in and out, are you following S&P gold, bonds, and dollar? You get out of the S&P, then would you look at the other 3 markets to see if they're above the 50? Ray, you are on it. That's exactly the next step. So if I have all of these other places that I can put my money, when I see that one starts to go up, the other goes down, I can now have an additional location to place my funds, right? So for example, let's use GLD, which is gold. So when I look at something like gold, if I'm going back on GLD now, this goes back. Let me go back as far as it'll go. All right, so here's my GLD position. What happened to the U.S. equity markets in the years 2008 and 2009? What happened to the stock market? Right? Let's just overlay those 2 markets. So here's GLD over top of SPY. Let's put them right over top of each other. Weekly chart. And we will go back. Oops, that's not what I meant to do. Weekly chart. We will go back. Time frame. Okay. So here is, let's zoom in on 2000 from 2007 to 2011. All right. So 2007 to 2011. So while the S&P was going down right through here, we saw that gold was rallying, right? So the S&P is falling all through here. We saw that gold started to really pick up the pace, right? Gold started to really gain in value at that time, okay? That's what we want to be able to do, is to move to different funds. Now, once gold starts to level off, you might then move to the AGG, the aggregate U.S. bond fund, right? Now, that aggregate U.S. bond fund's not going to appreciate as fast as those other markets. In no way is it going to appreciate as fast as those other markets, but it's also going to pay me a yield, right? And so I do also have the additional benefit of a yield that happens in there. So both the aggregate bond fund, now you don't have to use the aggregate bond fund. You could use something like the TLT, which is the 20-year bond fund, right? So both of them are potential replacements for that. But the idea here is that I utilize those funds as a way to take advantage of market conditions as they would start to do something like that. So as it stands right now, our line in the sand is intact. We've got nothing to, I've got no reason not to have my line in the sand somewhere very far away from current price. We are totally okay with that. With this number being right here, I think that's a perfectly fine number that gives you 200 and something points in the S&P for price to fall before you'd have to really worry. I will say that I think there's an additional chance that we still have that melt up scenario. And so take advantage of it, right? Take advantage of it. If you're not invested, be invested and understand what your opportunities are. But I think that the key is that you have some sort of an education around it. Now, if you're not managing your own retirement portfolio, I would ask why, right? If it's something that you want to learn a little bit more and you think you want to manage your own, but you're afraid to do it, let us know, right? We may be able to guide you and help you. I know that we're not the right fit for everybody, but if you've got questions, do me a favor, email us support@tradersarmy.com. If you don't already, follow us on Instagram and YouTube and Twitter and Facebook and all that fun stuff. But that's the idea, to kind of understand what's happening. Trent, great question. Chuck, for people new to candlestick charts, what's a good free website for accessing candlestick charts with moving averages? I would use Trading View. Trading View, I think, is the best one. So let me pull it up over here. I think that if you go to tradingview.com, they do a really nice job. You can go to chart right there, and it'll launch a candlestick chart website. And then very easily up here, you can add your ticker symbol. Let's just say you want to add the SPY. And change your indicator, change your thing here from daily to weekly. And so now you have this, and you can even add your indicator, which would be your moving average right here. So now we have a moving average on the chart. I can right click on it, and I can edit the settings of that moving average to the 50-week moving average. And there it is. Awesome question, Trent. So, all right. Well, I took us about as long as I thought we would tonight. For those of you that are not Traders Army subscribers, I invite you to go to the website, see if there's something in there that makes sense to you. See if it makes sense to come on board and become a subscriber. If you know somebody who's an investor, this is going to be recorded. We will gladly give you the link if you think that this would be of a value to them. I hope that you guys found this to be valuable this evening. Share it on your social media and all that other fun stuff if you would. I think that would be amazing. But tomorrow morning we will have a daily market commentary for all of you to feel free to join us and watch our daily market commentary. And I look forward to getting a chance to talk to you all real soon. Have a great day. See you guys later.